Before we start, a disclaimer. This media or any derivative of this media should not be construed as investment advice. The analysis shown here is intended to convey general concepts and not for specific investment recommendations. The creators of this media are not responsible for any losses arising out of investments in any kind of assets. Now, this analysis is only regarding capital gains, but there can be other sources of returns for Bitcoin or any other cryptocurrency. A quick look at Divided.com tells us that Bitcoin can be lent for interest up to 6.2% APR as of 13th November 2021. But we are not going into details of yield farming or lending cryptocurrencies here. So let us get back to our analysis. Our analysis currency is US dollars and the analysis period is 2-year period before 11th November 2021. That is, our analysis period is 11th November 2019 to 11th November 2021. Let us start our analysis with price trends. You can see on your screen that BTC prices, that is Bitcoin prices, increased rapidly, especially after October 2020. Now, there are certain limitations in analyzing assets based on only price data. The problem is that the price data is not comparable. How do I compare $200 increase in Bitcoin with $200 increase in any altcoin? Because they have different bases. So we have to consider something else. Apart from that, we cannot really understand the effect of volatility here. Volatility matters here because we are going to take forward-looking decisions based on past data or empirical data. So we have to consider something else, take a different approach, and that approach is looking into the return data. So what we have done here, that we have calculated the rolling 30-day return for each day in this period, that is 2-year period. So we have 365 into 2 data points here, and each of these data points signifies the return in the previous 30 days. So that is for the BTC. Now let us see the S&P. Now we can see that compared to BTC, S&P has been flatter. It is obvious it is much less volatile. Now, for easy comparison of the trends in the 30-day returns, we have normalized them and taken straight line assumptions of the trend lines. This chart can help us understand the difference between the growth rates of these two assets. Now let us do the same thing for 365-day rolling returns. As we can see here, after October 2020, the BTC 365-day rolling returns increased drastically, and now only it is getting plateaued in November 2021. But still, it is much higher than S&P 500. That is quite obvious. Now, if we do the same normalization of the trend lines for 365-day returns, we can see that after beginning of 2020, the BTC returns increased drastically compared to S&P 500. Till now, we looked into the return trends. Now, we have to look into the effect of volatility. For that, we have to calculate the volatility adjusted returns or risk adjusted returns, and one way of doing that is calculating Sharpe ratios. Now let us compare the average rolling 30-day returns for BTC and S&P 500. We can see that it is obvious that the BTC returns has been much higher, around 12% compared to 2% of S&P 500. Also, the volatility of rolling 30-day returns for BTC has been drastically higher than S&P 500. Now, how do we compile these two together? For that, we have to calculate the Sharpe ratio. And if we calculate the Sharpe ratio for 30-day period, the BTC Sharpe ratio has been slightly higher than S&P 500. But look into it that S&P 500 Sharpe ratio or BTC Sharpe ratio is not really good. So Sharpe ratio of 1 is considered good, and more than 1 is considered good. So this is not a good Sharpe ratio. So the reality is S&P 500 underperformed in this period, especially if we consider the 30-day returns. Let's do the same thing for 365-day returns. Now for BTC, the 365-day average returns, that is the rolling 365-day returns, has been more than 200% compared to around 20% or 21% of S&P 500. But the volatility of those returns has been also much higher in the case of BTC, more than 200%. But if we look into the Sharpe ratio for this 365 rolling 365-day return, we can see that the BTC Sharpe ratio is slightly lower than S&P 500. So if we consider in long holding period returns, that is 1 year holding period returns, S&P 500 performed better than BTC in terms of risk adjusted returns, and the risk free rate assumption we have taken here is 1.477%. Now till this point we have considered these two assets separately and we are comparing these two assets. What if we want to create a portfolio with these two assets? Like if I own S&P 500, how do I enhance the returns or risk adjusted return of S&P 500 using Bitcoin? For that, we have to start with calculating the correlation between returns of BTC and S&P 500. If we create correlation matrix for 30-day returns and 365-day returns, we can see that the 30-day returns are not really correlated between BTC and S&P 500, but 365-day returns are quite correlated because it is like 78% correlation. So what does it really mean and how it would affect our portfolio creation? So I have written a program that creates optimal portfolio based on the data, the return data, and the program gives me the optimal portfolio allocation based on 30-day returns is around 20% BTC and 80% S&P 500. And the portfolio Sharpe ratio increases from around, so we are adding BTC to S&P 500 and S&P 500 is our portfolio. So if we look into the S&P 500 Sharpe ratio for this period for 30-day returns, it was 0.29. So adding 20% BTC increases the Sharpe ratio to 0.39 to 0.39. But if we look into the long holding period returns, that is 365-day returns, it is a completely different scenario. The optimal portfolio is practically just holding S&P 500 and not adding any Bitcoin. For 365-day returns, the Sharpe ratio was 1.26, and for adding 0.3% BTC, it increased to 1.26. It's nothing. So is this the optimal portfolio? No, we cannot take forward-looking decisions based on only one analysis. So what we have to do is we have to take with different time periods and do the analysis for that and make a judgment call about the optimal portfolio allocation. Let's see how different time period, choosing different time periods changes the optimal portfolio. So till now we were doing analysis for 2-year period between 11th November 2019 to 11th November 2021. So let's do for 1 year, 11th November 2020 to 11th November 2021. We can see the Sharpe ratio for this 1 year period for BTC is 0.6 compared to 0.9 of S&P 500 for 30-day returns. And for 365-day returns, the BTC Sharpe ratio is quite good. It is 2 compared to 2.38 of S&P 500. So in this 1 year period, both these assets performed better compared to the 2-year period. Another thing I want to point out here that for both 30-day returns and 365-day returns, the S&P 500 Sharpe ratio has been higher than BTC. Now, what is the optimal portfolio for if we consider the data of only 1 year? the program gives me the optimal portfolio as for 30-day returns, BTC around 4.5% BTC and around 95.5% S&P 500. So basically adding 5% BTC to the portfolio. And for if you consider the 365-day returns, the optimal portfolio is around 2% BTC. So what can we conclude here? This kind of analysis can be helpful in deciding the optimal portfolio allocation. But to do that, we have to take different time periods and calculate the optimal portfolio allocation for them, and then make a judgment call based on the results of the program. We have to also include other factors such as economic factors, liquidity factors, etc. into making that judgment call of portfolio allocation. Now, apart from Bitcoin, we can also add multiple cryptocurrencies to our portfolio, and we will do that in the next video.